Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to talk about a couple of things. It deals with portfolio allocation. I'll talk about my portfolio allocation. It's not meant to be advice, just educational on what I am doing and my opinions around what I am doing. So I know a lot of people, they ask me questions directly about this, but all I can do is share what I do. So let's share what I do. So if we were to look at my portfolio, and a lot of people ask me, what percent allocation should I allocate to X? What should I do to this? What did I do? How did I lay this all out? And my portfolio is a reflection of my or of my conviction at the time that I had the money, and what was cheap at that time, and what I thought the best risk reward is. So my portfolio is a reflection of the opportunity I took in 2020. So my portfolio, if you were to look at just the equities side, it's overweight oil, nat gas, and energy service because I bought at a specific time that was very good for me to buy. My portfolio over time is a reflection and an accumulation of good buy points in different sectors. And whatever money I had at the time, I put it into those sectors, and that's how I diversified. So think of it this way. I'm gonna kind of switch it up and talk about something a little bit different here. Um, let's say you're gonna go buy something for your house, all right? And you go out there and you were looking to buy things. Uh, the best thing that you can do if you want to get the cheapest price is you buy things in the off season. So you're buying swim trunks in the fall, you're buying winter hats in the spring, you're buying cars in the off season, you're buying homes when interest rates are the cheapest, generally in the winter. December, January is usually when they tend to bottom. And you just do that all throughout the season. You're buying the things that are out of favor. And you're buying shovels in April or May when they're 75% discount. I do the same thing with stocks. It is literally the same thing. The thing that people don't know is, how do you value these things? That's where I developed the three pillar strategy. And it's not something that I read in a book. It's something that I just came up with myself, because that's what you do when you're an engineer. You like to develop processes or systems, and then you apply it, and then you refine it, until you get the desired outcome. So the three pillars that worked for me were technical analysis, market conditions, and then ratios. Ratios tell you where the money is and isn't. Market conditions tell you when that money's going to rotate into your sector that you're interested in. And then technical analysis is an unbiased approach to ensure that you're buying something cheap and that you can see the money flowing, and that your entry points are exhibiting what the herd would structurally build before a big bull market. That's really what it is. It sounds very simple. It is simple. It is simple to apply in practice. What becomes difficult is holding. That's the most difficult part. It's easy to buy something that's cheap. It's easy to buy something that looks very good, and then all of a sudden you still get a 30 or 40% correction, and that does happen. And the holding part is the hard part, because you have to have a sort of faith in the system or the process that you're implementing, the strategy that you have. And that's the strategy I adopted, and it works for me. And I take a longer term approach. Now, let's say you nail the strategy. Okay, you nail the strategy, you nail kind of the timing to some degree. And then how do you apply it? How do you apply knowing, let's say we know that these sectors are cheap. How do you construct a portfolio around that? What looks good? What would you overweight? What would I underweight? What would I overweight? What would I underweight? I say you, but it's me. So what would I overweight and what would I underweight and why? How would I construct the portfolio for the commodity bull market that potentially could be coming? So I've got the strategy there, the three pillars. That's kind of how I'm deciding where to implement money. I'm not implementing it all in one time. I'm implementing it in sectors that are cheap, much like buying shovels in April or May. it's that same approach. I'm buying things that are out of favor, that are very cheap, big upside, little smaller downside to get me the symmetry. It's called asymmetric investing. You got your downside. I'm just going to throw out a number: 50 to 100% your downside in all reality, but your upside could be 10, 20, 30, 40x or more. So big upside, smaller downside, very small downside. So how do you construct a portfolio? What are you looking for in the markets? What is considered to be a home run? And why is it a home run? What have I learned over all the years of investing? And where should I be looking if we do see opportunity? How can I identify the opportunity, size up the position correctly, and ride it into into profitability that hopefully changes your life? I mean, that's really what we're here for, right? That's what everyone's searching on YouTube for. They want to know the golden ticket. And I'll tell you, it takes work because you're going to have to hold on, period. It's going to take work. I could give you 20, 30 baggers, but you're going to have to sit there and hold on to it during the bull market. Easier said than done. Some personality types can ride through volatility. Other personality types can't. So let's talk about volatility. You're going to set up a portfolio. It is dependent upon the person who can ride volatility or can't ride volatility. I can ride volatility. I have done a lot of things in my life where I've been told no. I've been told you're not good enough. I've been told that I didn't make the team. I've done lots of working out. I was a mid 600 pounds deadlifter at some point in my life, and it didn't get there in 2 or 3 or 4 or 5 months. It took me many years of building, developing, and strengthening with setbacks along the way. It's very similar to investing. I was in very competitive baseball, very competitive hockey. I played with professional athletes when they were young. Play with these people, there's going to be teams that I'm not good enough to play on, and sometimes they say I'm not good enough to be on the team. It's a setback. You've got your emotions and you feel bad that you didn't make the team, but guess what? Got to keep going, got to learn more, got to refine, get better, and keep going. Investing is the same way. It is exactly the same way. You're gonna get some wins, you're gonna get some losses. Don't let the losses affect you. Okay, I get it. I lost this position. Move forward, keep going. That's the mindset that you have to adopt. Volatility is a part of the game if you want to push the returns to the upside. You have to live with volatility. You need to adapt to the game. The game isn't going to change for you. You need to change to the game. The game is you want 10, 20, 30 baggers, you've got to ride volatility. Period. I don't know of any time outside of using massive leverage where you're not going to be able, where you can avoid volatility and pullbacks in the market. So if you're going to play the big long-term, big picture move, you're going to have to live through volatility and pullbacks. Volatility is pullbacks, volatility, day-to-day movements, where it goes up, pulls back, goes up, pulls back. And you have to be comfortable with seeing a negative in your portfolio at one point. The toughest part is when you're deploying money right in the beginning. There's times where you could misprice it and you're 20, 30, 40% down in a week or two. That could happen. You think it's going to break to the upside and comes back down. Or it does a false breakout to the upside and then breaks back down, which happens all the time. There's news. There's all these things in the market. The way that you win is, what do you do after that happens? What do you do? Do you buy more? Do you sell? Do you get scared out? So here's one thing that I learned. Price is not a function of the fundamentals in the short term. Price is not a function of the fundamentals in the short term. You can have really big chart pattern setups that has volatility in the short term. The big pattern and the fundamentals generally align. The technicals and the fundamentals are the same thing. So you have to understand that when you set up this portfolio that you're going to be moving up and down. Your valuations could move up and down dramatically if you're trying to, I'll call it, swing for the fence with individual companies that can have 30 plus bagger upside potential. So that volatility is there. No matter what you do from a technical analysis standpoint, you could get that. You're going to get that volatility in the short term. I don't think there's any way around it. So you need to have a personality type that can withstand that type of volatility and not emotionally get afraid or scared or have control over the outcome, because you don't have control over the outcome. So when you look at the portfolio, the way that I view, again, it's my viewpoint, I look for cash flow rich companies. Can this company generate cash? The answer is yes. And they are currently generating cash, a good amount. It's a good opportunity to overweight it in the portfolio. So what does overweighting look like? That could be 5 to 10% of your portfolio. Something like that is a good overweight. Now, if you look at the company and you can't see a path to positive cash flow, there's no path that you can see within the next few years. That's high risk. Do they have a single mine? High risk. Single country, single mine, no cash flow being seen in the future. It's a high risk company. I'm not putting 10% of my portfolio in. I'm sorry. Maybe a few percent, 1-2%. Now, some people can look at my portfolio and they'll say, why do you own so many companies? That's the reason why. I cannot overweight these small little companies with no cash flow or anything. So I can't put a big percentage in it. So what I do is I start to develop strategies around it. Okay, so last bull market, these guys that had no cash flow went up 10, 20, 30x. I'm talking about uranium companies in particular. And the whole sector, it seemed like they all went up a good amount. So it's okay. Maybe I can allocate 1-2% in a position and carry 10 of them that I think possess the traits that could go up that amount, and they exhibit technical patterns that show that people are accumulating it and that they could have big moves to the upside. So rather than trying to guess which company is the best company, even though I can guess that, maybe I put 1% in each, and the ones that have the strongest technicals, ones that could potentially find something that I have more confidence in, I can overweight those. But they're still not overweight compared to the portfolio. They're overweight for that section of Uranium Explorers. So maybe I put 2% in some and 1% in others. I've got a group of 10. I don't know, whatever it is. So I've got these 10. And that is a strategy. My strategy is what I just described. Doesn't have cash flow. I can't see where they're going to get cash flow. But they did well last bull market, and the upside potential returns were ludicrous. So I'll put a little bit in those. So then you got these other companies. They're big kind of, we'll call it like massive stalwart companies, right? They're the big boys in commodities. They're the diversified mining companies. They're the major royalty companies in gold and silver. They're the big boys that are paying big fat dividends in oil and nat gas, or maybe energy service. Is there any in that area that are way down that have a big upside potential? That is what I'm going for. Some of these companies last bull market that were larger did over a 10x from bottom to top. Over a 10x. Some did 20x. Now, is that enough upside potential? Yes. Yes, it is. So really what you start to do is you start to ask yourself, how much risk am I willing to accept against the standard? Now, you're going to have to look at the delta of potential returns between a 10 or 20 bagger in a big company versus going up the risk curve to get a little bit more. Is the juice worth the squeeze? And that's the question that you have to ask. Maybe it is, maybe it isn't. For the most part, since the probability of success in some of these, say, gold and silver junior mining companies is pretty low, I'd favor the bigger ones. And maybe there are certain sectors that I favor that have bigger returns than other sectors. Then you have to look at the market conditions. Your market conditions will determine how much money you may want to allocate. What's cheap? How cheap is it? How much downside risk and how much upside potential is there? When I went into oil, it was a ton of upside, very low downside risk. The risk at that time were companies that had debt could go bankrupt. There were some companies that went bankrupt in 2020 that were shale plays and stuff like that. And that is your risk. But they got sold off pennies to the dollar, and some of them didn't go bankrupt, and they just rocketed on up. So that was your opportunity. So that's what I did, is I overweighted some of those. I knew they were a little bit risky at that time. There was accumulation in them. They had the technical chart patterns that people were accumulating, thinking that they weren't going to go bankrupt, and that's what I used to establish big positions in some of these companies at very low points. I overweighted them because I saw a path to cash flow. They had the infrastructure in place where they could generate billions of dollars in cash, and they were priced like they were going to generate nothing. So that was the misvaluation in the market. The ratio was off the page cheap for oil, et cetera, et cetera. And that's why I bought them. I bought them because I could see the path to cash flow generation. I knew that they were incredibly cheap. I knew they had debt, and I knew that they were sold off to pennies on the dollar because of the debt. That's the special sauce there. So then when you look at uranium companies, I'm just going to give an example for uranium. The reason I can't size those companies up like I did in oil and gas is because I don't see the path to cash flow. So even though I could see the potential returns being absolutely ludicrous, I just don't see how they are going to generate cash. Now, why is generating cash so important? I can tell you that. When you generate a bunch of cash, you can control your destiny to some degree. What does that mean? So you've got an oil and gas company. Let's say they're out of favor. You've got an oil and gas company. They're out of favor. No one's buying them, and they are incredibly cheap. What the company can do if they're generating a bunch of cash is they can take that cash and do something with it. They can say, we're going to buy back shares, reduce our share count, and push the earnings per share up. They're literally pushing the stock price to the upside with increased buying pressure. So that's what share buybacks do. 2, they can use that cash flow and pay you money in dividends. So you've got share buybacks, and they can pay you in dividends. So if you're in it, you've got a big return because let's say some sentiment went from very, very fearful negative sentiment to more positive sentiment. So money flowed back in. You're sitting on a 5-bagger, 4-bagger, whatever it is, 3-bagger. They're making a bunch of cash. They're still cheap. They pay down their debt. They extinguish their debt. Then they say, my stock's cheap. I'll just start buying back my stock, or I'll start giving you dividends, or a combination of both of those things. So as an investor, you win. You win because the stock price goes up eventually because they're buying back shares, reducing the share count, and your earnings per share go up, and your dividends go up if they're buying back more shares and they're paying dividends because the cash flow is being distributed amongst less and less shares in the market. So I know some people view dividends as negative. They're like, oh, this company's not going to grow as much. Not me. I think that the companies can still grow quite a bit. You can still get a 10-bagger and get a big dividend along the way. Why not? That's perfect for somebody like me. And you have to look at the risk. What risk are you taking on? and how much do you want to allocate to the risky stuff. For me, I don't want a portfolio that's 50, 60, 70% high risk stuff. There's no point to me to do that. It's too much risk. So what I look for is what are really low risk opportunities that I can buy at perfect timing. So what does that mean? Where can I look in the market with the lowest risk that has very good upside potential, which means your risk reward is just, it's blowing out. I'm going to show you one of these opportunities of what it looks like right now. So right now, I'm going to show you gold and what that looks like. So this is more trust required, less liquid, harder to sell. It's further away from real wealth. This is less trust required, more liquid, easier to sell, and closer to real wealth. And that's gold. That's real wealth. Paper money, government bonds, treasury bills, corporate. So what happens here is when these things start to go bad, the derivative market will go bad. Some of these could go bad, and money flows downward. It flows down. This is called Exner's pyramid. It flows down Exner's pyramid downward. So, in my opinion, we could have problems right above gold. We could have problems in the government bond market and treasury bills, more particular government bonds, which is going to flow in, have problems with paper currencies, which is going to be inflation, which then money flows downward into gold. Gold, silver, platinum, whatever metals that you want to talk about. So I think that there's a huge asymmetric opportunity in precious metals because of the risks associated with everything on top of it. And I think that the risks right above it, paper money and government bonds around the world, it's going to be considered riskier than what it was in the past 100 years. So money's going to get scared and it's going to flow downward into the assets that require less trust, that are more liquid and are closer to real wealth. So what does this setup look like? Mexico, by far the largest silver producer globally, is experiencing a nearly 20% year-over-year decline in its operations, making the most significant drop in 4 years. The supply and demand case for silver remains incredibly compelling. This is Peru silver production. You can see back in 2016, 0.36 million ounces, and we are way down here at 0.25. A big decline in silver production in both Peru and in Mexico, Mexico's by far the largest silver producer in the world. And what's happening is that production is declining around the world for silver. This is the gold supply forecast from Barrick Gold. Industry is facing production precipice. Very few companies able to deliver value growth in this environment. From 2020 onwards, we see a decline in the production or supply of gold over time. And every single time we've seen this supply contract like this, we've had massive bull markets in gold. So this is what's coming to Barrick's forecast of what is coming to the supply side of gold. And again, silver's experiencing it, gold's experiencing it, and even platinum's experiencing declines in production, which I'm not going to show. Stages of a stock market bubble. Displacement, boom, euphoria, peak, and collapse. Generally, you get a bull trap, and this is called a bear trap. Bear trap, bull trap, and then we get a collapse. And then we usually get a double bottom. This is one bottom, and then the other bottom's here, called displacement. So this is really what happens is when you come down here, you generally get a double bottom. A double bottom is you come down, you bottom, hit a resistance level, bottom, you break through that resistance level, and then you get a flag pattern or a pennant formation or a falling wedge. Something like that occurs towards this area. That's the ideal buy point when you go and you look at technical chart patterns that you see. In my opinion, when you start looking at the valuations of gold in relationship to other commodities and other assets, Like this one here is gold in relationship to the M2 money supply. As this comes down, this is your bubble in 1980. Why is 1980? What's so significant about that? Well, that's when gold accounted for the money supply. Gold accounted for the money supply, and then it had not done that since. And if you look at this, your peak, you come down, and then you get a collapse. So this is your peak. It comes down, it bounces back up. This is your bear trap right here, and then it comes all the way down into the valley of despair. That's what I call it, despair. And then you get a double bottom. You get a lead-in pattern. This is bottom one here. Remember 2000, this was another commodity bull market that occurred under a declining interest rate environment. That is why it didn't break and move up to the top here, is because the interest rate environment was not ready for it. Then we came back down again into our double bottom. And we're at that point that is down here for the ratio. We're coming to displacement. The reason this went into from 1980 to where we are today, in my opinion, is because of interest rates. Interest rates, again, this is the market conditions that I'm talking about. This is the ratio we're using for valuation. This is the market condition that caused that discrepancy, in my opinion, and we're using technical analysis to validate all this. Rising interest rate environment, this is in 1980. You can see the peak in interest rates there. 1980 is the peak in the gold price versus the M2 money supply. Why am I going over that portion directly? It's because the conditions in the 1970s with high inflation, increasing interest rates, caused a rotation of money into gold. We also had these same types of pullbacks in production and supply that we have today. So we've got the increase here. If you notice the trend line break in interest rates and the move to the upside in interest rates. So we have a new shift to an increasing interest rate environment. We've broken the declining rate interest rate environment, and what I think is going to occur is that this is going to go to the top here and then break and go all the way back to this level up here. The price of gold at this point is going to be like astronomically high. I don't even want to give, well, if you were to calculate it, it's going to be in the tens of thousands of dollars. It may be like $40,000 or $50,000. Depends how much money they create, and it depends on how scared people get in the system. This is another indication. So this interest rate back here from 1980s, that end of trend head and shoulders pattern that you see the three white lines, that's a head and shoulders. We break down and we go all the way back down. This environment is pushing bonds around. This is our future money flow transition. So money in 1980 went from gold, 1980, 79, 80, it went from gold, and all of this money here that came all the way back down to 2000, that money went into bonds. That's why in 1980 we can see a big move in the bond market. So it says the bond market appears to be reversing its historic shift of the early 1980s. The interest rates declining and the environment that we were in, money went into bonds and priced bonds all the way up here. Now, you could draw a simple trend line, and all you have to do is look at the yields, because yields and bonds are inversely correlated. So yields have broken to the upside, bonds have broken to the downside. This here, the bond prices coming from 0% interest rates here are going to reverse and come back down. That is the fuel for gold to go higher. That is what is going to rotate, is the money leaving bonds and probably stocks too, to some degree, because of the increasing interest rates and moving into gold. That is what's going to happen. So how do I know that? Well, central banks have been net buyers of gold for over a decade. That is what happens. Stealthily buying it in '08 or '09, 2010, 2011, 2012, 2013, all of that. Notice in history, there was only a couple of times that that occurred. A little bit towards the end, 1980, 1979, 80, 81. We saw it in the late 60s, early 70s a little bit. So we had net purchases here, and then really they were sellers from 1990 all the way into 2010, so to speak. That's what's causing this dip here. Sellers in the 90s, a little bit of buying here, coming up in 2000 for the price, and then more selling pressure, and this is going to come all the way back up because of the buying that central banks and people, retail sector is going to do in the future. The interest rates and the selling pressure in the bond market is going to cause a paradigm shift in the people's thoughts. So this is the S&P 500 versus the producer price index. We're coming up to another era for bull era for gold and silver. This is another way to look at the potential movement of money. That's what this ratio is telling us. It's basically breaking down against the producer price index, the S&P 500 is. And we can see a big shift of money and a rotation of assets. Same with sugar and silver. Same thing. We're going to see a breakout here and a big pattern break over a 50-year base. Silver's got a 50-year base. Sugar has a 50-year base. Orange juice just broke out of a 36 or 40-year base. And these things are going to run uncontrollably. It's going to be ridiculous. This is quarterly gold versus the S&P 500, another one that's got that double bottom, bottom one, bottom two, and it's going to come up. It'll probably break out, do that. They'll do exactly what the double bottom has. It'll double bottom, break out, and do a pullback and do a retest. And we're buying the retest on a lot of this stuff. So that's probably what it's going to do. We've got I threw uranium in here. Uranium versus the S&P 500, 43 years, another double bottom. You've got the lead-in pattern, draw a line going across, double bottom. And all of this is in alignment, guys, all of it. Upward handle, that's the cup and handle here. Your cup height is your profit move. That's the biggest cup and handle I've ever seen in my life in silver. And what Stan Druckenmiller says, the way to build superior long-term returns is through preservation of capital and home runs. When you have tremendous conviction on a trade, you have to go for the jugular. It takes courage to be a pig. And I just wanted to end on that for this presentation here. But looking at all this stuff, right? So coming back and talking about portfolio allocation. What's the least risk thing out there? Gold and precious metals, according to Exner's pyramid. Could we have a credit problem? Yes. We see a 50-year chart pattern, big long term. We see all of the technical analysis that aligns with, big cup and handles, all these things in terms of ratios that are really low for gold, really low for silver, that could break to the upside. You have an opportunity to buy the least risk thing in the world with a bunch of upside potential. So what I did is I'm allocating about 20 to 30%, somewhere in that range is my allocation. I don't know the exact amount. It's somewhere in there of what I do to ratio investing in physical metals. Physical metals. Why did I do that? I just went over the reason why. No risk. The risk is as low as you can get. It's got a ton of upside potential. Back in the 1970s, gold went up 23 times, something like that, 23, 24 times. Silver went up 50 times. What is the risk that you're taking with the physical metal that has something with the upside like that? That's unheard of, guys. It's unheard of. So I'm allocating a big portion of my portfolio to that because of the risk-reward profile of it. That's what I'm doing. Now, in my equities portfolio, so I've got 20-30% of my net worth. And then my equities portfolio, which is kind of the other portion of it. How do you want to how do you want to break up the risk in that? And how did I do it? The way that I did it is I wanted to see cash flow. If they pay dividends, perfect. I'll buy dividend paying companies in larger amounts. There's opportunities in the markets right now where there are dividends being paid between 10 and 30%, 10 to 30% dividend yields. I overweight I overweighted those in my new money that I'm making, and my dividends that I'm reinvesting. I'm allocating to these dividend payers larger percents here recently. I'm snowballing my dividends. So now I'm creating a portfolio. I went after at some portion of time the big return, small downside risk where I can get 20, 30 baggers. I'm allocating money over to um, dividend payers to snowball dividends. It's another approach or strategy that I'm using. Lower risk, big cash flow, and I get dividends. Why am I doing that? If we're coming into a very highly inflationary period, I'm going to need more. I'm going to need more money. I need more. I need to kick more money into my accounts from inflation protected assets. That's why I'm doing it. Then you've got the swing for the fence, full risk. I don't see cash flow potential in the next year or two. I'm allocating smaller amounts to those because the risk is higher. They can't, and remember the risk of dilution, the risk of raising money, needing money that they can't raise in a high interest rate environment for a mine. There's a lot more risk there. Something happening to the mine under development. There's all these things that can happen that are risks in a new mine being built and in a jurisdiction that potentially doesn't want the mine. Maybe they said, yeah, it's good, but now they changed their mind. Maybe they want to nationalize it. There's just a bunch of different risks there. Then you've got the precious metals portion that I see with very low risk, very, very low risk. Everything that government wants to do around the world is shut down mines, is tax them more. They want to nationalize them potentially. Everything that they're going to do is going to increase the price of the commodity and hurt the production or supply, it seems like. And if they get desperate enough, there could be war going on in the particular area that they can't mine. There's all these things that could happen. So I think the physical metal is a very low risk way to play it. And that's my opinion there. So that's kind of how I structured my portfolio for the bull market. I've got my dividend payers. I've got the ones that are a big chunk in cash flow rich companies that are growing, that I'm buying at very opportune times across a bunch of different sectors. That could be uranium, oil and natural gas. It could be shipping companies, iron ore, steel. It could be copper, diversified miners. It could be whatever it is, commodity related. And I've got my dividends to pay me more. And that's kind of how I laid it all out. Right, wrong, or indifferent, let me know what your guys' opinions are in the comments section. But that's how I'm playing it. And I've got coal too. I'm going to start buying some coal companies that pay big dividends. I'm going to start loading up on those too. And I'm just going to keep going. Keep accumulating, keep the dividends going, and snowball the dividends for a while. Again, if you guys are interested in learning what I'm doing, if you're interested in setting all this stuff up, how I'm doing it, you can always subscribe to the finding-value.com if you'd like. Use the word discount and coupon code for a discount monthly. For the first month, you get a discount, and then the yearly, you get a bigger discount if you want to sign up for a year. But that way you can learn it. You can see that's kind of how I structured mine. I'm not as risky as perhaps some of you. I know some people are very heavily weighted in certain sectors, and they're in very high risk companies with a 90 to 100% of their portfolio is high risk, and I just don't have. It's not having the cojones. It's just the probability of success isn't high enough for me to do that. But it may work out for you and maybe you absolutely kill it, which I hope you do. I will not be jealous. I hope you do. Anyone who takes that type of risk, it's good, could be well deserved. And the volatility riding through it. Another thing that I'll say is I find a lot more comfort in knowing that the company can generate a lot of cash. They're not going to go bankrupt. They don't need to raise money and all that stuff. I won't be diluted. And it gives me ease to hold it through thick and thin. It's much harder for me to hold through thick and thin on a company that I know cannot generate cash. Like it's like, yeah. So I don't want to put a lot of money in it because it makes me uneasy to hold through volatility and large pullbacks because I don't believe in the company so as much as a company that can just generate and spit cash right into my account, or they're buying back shares where they can kind of have at least some control over the outcome of the price of their shares. So, and again, I look at every single sector like I did at the gold sector there, where you've got declining supply, you've got increased potential demand, you've got low downside, risk, looking for patterns, double bottoms, looking for things that are in the valley of despair or broken out, putting in their patterns and buying them at the ideal buy point on a double bottom, looking at all that stuff. So that's what's coming, guys. And all of the commodity sector possesses those bottoming patterns, like almost everything, which tells me that something's coming, I think, with the currency. That's my guess. Why do I guess that? Because inflation is what's going to drive it. It's going to be credit expansion at a faster rate than the supply in all these different commodities. And people are shifting money to those areas based off the interest rates and the bond markets. So that's what I've got for today, guys. Hopefully you enjoyed it. Give me a thumb up for the content, subscribe to the channel, and we'll catch you guys next time. This is Finding Value.